Yogesh Dayal to take over.
To this post-policy press conference. This is the last for the year, and we'll be today interacting with media friends who have come from all media agencies, all media houses been represented. So first of all, I'll welcome the Governor and the Deputy Governors, Shri M.K. Jain, Dr. Michael D. Patra, Shri M. Rajeshwar Rao, Shri T. Ravi Shankar, Executive Directors Dr. O.P. Mal and Dr. Rajiv Ranjan, along with my colleague from MPD Munish Kapoor, and the media friends. Welcome to this press conference. Before we go ahead, sir, I would request you to make some opening remarks so that we can get started with the press conference.
Thank you. You see, what I have done is that, as I have been doing in the previous Monetary Policy Committee press conferences, I have tried to summarize, the statement, the detailed statement which I made. I have tried to summarize them. And in this context, I would like to highlight 7 points. First, this basically emanates from whatever is there in the statement, but to just put things in the perspective, I would like to say as follows. The first point is that the Indian economy remains resilient. It has withstood successive global shocks over the last 3 years. Each shock came with unprecedented suddenness and spillovers. Major economies are still reeling under their pressure. However, Indian economy, amidst all this, remains resilient. The second point is that inflation has shown signs of moderation. I repeat, inflation has shown signs of moderation and the worst is behind us. But there are concerns around core inflation. We cannot take our eyes off inflation. Third, we are now witnessing conducive conditions of macroeconomic stability as reflected in moderation in inflation, fiscal consolidation, and the expectation that the current account deficit is likely to narrow in the coming quarters. Fourth, the Indian rupee has remained one of the least volatile currencies among its Asian peers in 2022 and continues to be so this year also. Fifth, the real policy rate has moved into positive territory and the banking system has exited from the Chakravyuh of excess liquidity without causing any disruption. Monetary policy transmission is also picking up. Sixth, on liquidity, the Reserve Bank will remain flexible and responsive to the requirements of the productive sectors of the economy. And seventh, and the final point, is that we in the Reserve Bank of India stand resolute to deal with all future challenges. I'll stop here. Thank you.
Thank you, sir, for those opening remarks. I will start the press conference I'll invite Mr. Govardhan Rangan from Economic Times to ask his question.
Thank you, Yogesh. So good morning, Governor. With this policy, probably you're not surprised, you just met the expectations. But in terms of the future outlook, your inflation forecast for next year is 5.3 and the Q4 of next year is at 5.6. If one looks at when there is a consensus among all the central bankers that inflationary pressures is easing, you yourself mentioned, but what is the reason for forecasting at 5.6%, which is higher than what the MPR forecast in the last edition? So why is there? What is that has made you increase the forecast for next year fourth quarter? And what is the message with the two of the MPC members already saying that we have done enough? So how does one read this in terms of messaging as to what is that in store?
Okay, I would request Deputy Governor Michael Patra to take that question.
Sure. Yeah, as you mentioned, the average inflation is actually lower in 23-24 than in 22-23. And you specifically mentioned the second half of the year. That is because of the base effects of this year playing out into there. That's why the higher inflation.
In terms of the widening difference within the MPCs when the external members are saying that, okay, you've done enough and the inflation is easing. So why is that, still there is kind of an indication that there may still be rate hikes and, okay, not a pause?
No, ultimately the MPC decision is the majority decision. And with regard to indication, it's not possible to, say anything. I have said it earlier also that in the current tightening cycle especially with regard to rates, we have refrained from giving any forward guidance because sometimes it can be, and quite likely sometimes, it may become counterproductive. So we are not giving any forward guidance. We have said that we will be extremely watchful of the incoming data as well as the outlook on inflation as well as what is happening in the overall economy. Based on that, we will decide going into the future months.
Thank you, sirs. Thank you, sirs. I'll invite Mr. Anand Adhikari from Business Today to ask his question.
Good afternoon, sir. Sir, I have done some analysis of, those three food items. I was looking at the CPI, basket, and I have seen cereals, eggs, and spices. Consistent.
Cereals?
Eggs and spices. So there have been a consistent rise since May, month on month. Cereals and, spices, I think, not even a single month that has gone down. In case of eggs, they are, prices are high, but in the last 2 months, we have seen at least 5%, rise in the last 2 months. I just want to know what is your assessment of these three items, in the food basket, and will they remain sticky?
You see, each component of the food inflation, or let me put it this way, each component of the headline inflation, and beyond that, each component of the food inflation, the core inflation, and the fuel inflation, each of the components, the momentum, that is the month-on-month momentum, are very closely examined by the MPC and by our research teams within the RBI. And based on that, we give out certain statements. Like, for example, I have said that the moderation in vegetable prices in the last 2 months, that is in November and December, they more than offset the price momentum in cereals, and I have mentioned 1 or 2 items there. So we are examining all these components, and the future trajectory of each of these components, the month-on-month momentum, it's all built into our projections.
Thank you.
Thank you, sir. I'll invite Mr. Vishwanath Nair from BQ Prime to ask his question.
Good afternoon, Governor. In your statement, you mentioned that banks have come out of this Chakravyuh of excess liquidity. You're also pointing out that the deposit rates are rising between May and December. You pointed to 13 basis points on weighted average term deposit, fresh deposits. Having said that, since the last policy, the gap between the credit and deposit growth has reduced, but it still remains quite wide. As the prospects for credit growth are rising sharply still, how long can banks continue having this 400-500 basis point gap between the credit and deposit growth rates?
You would like to take that, or Jain will take that? I think I would request DG Michael Patra to take that question, and DG Jain can supplement thereafter.
Yeah, as you point out, the difference has narrowed, but there is still a difference, and it's really up to the banks to mobilize deposits and make up the gap. They are doing so through certificates of deposit and reducing their non-SLR investments, but they need to mobilize deposits on their own to meet the gap.
Thank you, sirs. I'll invite...
Just a moment. I would request DG Jain to supplement.
Okay, I will supplement what Dr. Patra has talked about it. There is an increase in the deposit side also. The sources of funding we have analyzed, and we have seen that the sources of funding are coming from deposit as well as the borrowings. The CD ratio as of now for the banking sector has increased little bit, but still reasonable within the range. And the liquidity coverage ratio is still at very comfortable level, much higher than the regulatory prescription of 100%.
Thank you, sirs. I'll invite Ms. Lata Venkatesh from CNBC TV 18 to ask her question.
Thank you, Yogesh. Governor, 2-3 questions, please. So this
It will
real
be
policy
good if you
rate...
can ask one, because...
The real policy rate, you said that, now 5.6 inflation and 6.5% repo rate. but the 1-year T-bill is trading at 6.95. So effectively, if you take 5.6% inflation, the real rate is already about 140 basis points, 130 basis points. Will you be guided only by the pre-COVID, which was, I think, 230 basis points difference, real positive rate? So what will guide your decision to pause? Or will it be also actions of other central banks? And if I may, so what is the total exposure of the banking and the NBFCs to the Adani Group? Because we just heard that REC has 7,000 crores. So is there a number that you all have already assessed? And if you can tell us whether you would be cautious that that number shouldn't increase.
Okay, and now the first part of the question, relating to that real rates and all, Dr. Patra can take, then I will take over the next question. The next part of the question.
So as you point out, we have nudged
Put the mic on. Yeah.
we have nudged the real policy rate into positive territory. What its level will be decided by the evolving macroeconomic configuration. So it's not necessarily guided by pre-pandemic levels or anything, but by the evolving growth and inflation trajectory.
130 is big. No real rate.
No, actually, we're talking about the real policy rate, right? So you take the policy rate and adjust it for 4 quarters ahead inflation, as we've always done, and you get less than 1%. You get 0.9. Okay. And about foreign banks and all that, we take into account all developments in the world, but monetary policy has an exclusive domestic orientation and it will react to domestic developments.